Graham, BM2 Logistics, here with Zach Rogers, Colorado State University Associate Professor of Supply Chain Management, here to review January's Logistics Managers Index, LMI for short. We are here to hypothesize when the balance will happen in the transportation market, when those bottlenecks will ease up. So in the meantime, we have all kinds of indexes to review, discuss, and share with our audience. Zach, how you feeling?
Good, good. No, I mean, better than, some of the people we're about to talk about, probably for sure. Definitely better than, say, a grocery store who needs to find a truck for something that's going to expire soon. Feel a lot better than them.
Well, hopefully they're getting paid accordingly for their frustrations daily.
You hope. You would hope. But we got a bunch of that to get into. So I'll pop my screen up here. And we can talk about this month's LMI and then a couple other numbers too that I think kind of tell us about what's going on. So Logistics Managers Index, we talk about this every time, but just to remind anybody, anything over 50 means growth. Further over 50 it is greater level of growth. Below 50 is contraction. Further into 50 it is the greater the level of contraction is. And you can see our survey instrument we use here, we ask folks about inventory levels and costs. And then for warehousing and transportation, we ask about capacity, utilization, and prices. And basically say going up, going down, staying the same. And, we've got a whole bunch of folks answering this. And it's funny, if you look, so, now that 2021's wrapped up, unsurprisingly, it was our highest ever average for a year. Normally, I think our average LMI over the 5 years, even including last year, so it's pumped up a little bit. The average is like 62, which is a pretty moderate rate of growth, what you would like to see. And with January's reading of 71.9, we've been above 70 now. Been above 70 now for 12 straight months, so a whole year. And 70 is kind of what we would consider to be a really significant rate of growth. So fast expansion is when you're at 70, and we've now been there for 12 months. And it's interesting because when you look at December and January from last year, that's the only time really for the last 18 months we've been below 70. And that's the sort of normal pattern that you would see, right? Is, okay, we get into late December, get into January, we run those inventories down, right? We built up this crescendo in Q4, and now inventories start to drop down. That didn't happen this year. Let me show you another picture. This picture, which is in scarlet and gold for my really honestly, I would like to say overachieving and gone too soon 49ers, but if I'm being honest with myself, they made it way further than they should have. But I still have it with the red and the gold. And the red line here is inventory cost, and the gold line is inventory levels. And this is so interesting. Okay, so you can kind of look, and I set this back to January 2020. So you kind of go back to the start of the pandemic. And I think it's funny, that they're normally about 9 points apart. That's the average pre-pandemic, about 9 points apart. If inventory levels go up, costs go up. If inventory levels go down, costs go down. Then you go forward a little bit. Okay, you go forward a little bit, and you see inventory levels actually were a little higher than cost that 1 month, right in like May last year when we were at the height of lockdown. And then since that happened, we started spreading apart. And it reached kind of the peak in terms of the difference in November last year. So November 2021, they're 28 points apart. We were at 87.5 for cost and only at 58 for inventory levels. And that's very weird for them to be almost 30 points apart. And so you might look at that and say, well, gosh, it seemed like there was a lot of inventory everywhere. And there was. But the reason inventory levels are so low is because the velocity that inventories were moving at. So inventories were coming right in, and they'd be on the shelf for like a minute and then go out the other side, whether that be an online shelf, a digital shelf. Inventory was moving
back order
really,
fills,
really
whatever it is, right? I mean, it's inventory to sell, right? If you don't have anything to sell, right, you're not obviously making any profit. I'm curious what the cash to cycle looks like, compared to, the inventory, right? we pretty much omit, right, the just-in-time models, albeit super slick and awesome when there's a balanced marketplace. When I say market, transportation market, right, where there's few what they call bottlenecks, right, that we've talked about in the past to get through to the end customer, right? Then you're like, hey, we're our demand playing way upstream, right? But now we're really like, what are we looking out for, right? The bullwhip effect, right? All
Well,
of a
and that's
sudden we're
what's
gonna have too
happening
much
right here.
inventory and the velocity is gonna show down, and then hey, we got a lot of extra widgets, which obviously those secondary markets we've earmarked before will obviously they're doing well now, but they were really, really doing well, right? Because they're gonna be flush with inventory. So um yeah, when's bold prediction, when's this all gonna happen?
So let me just give you a little more context before we get to bold prediction time. So bold prediction, by the way, is Rams and take the over. That would be my boldest prediction for this week. But for supply chain, I would say you got to look. So we had that 30-point gap in November, and then that's basically cut in half in January. And so inventory costs are still growing at a pretty good pace. But suddenly inventory levels are in the 70s for the first time in 4 years. We have inventory really starting to accumulate. And here's what happened, basically. It's just like what you're saying, Jonathan Bullwood. We have it's hot consumer demand. We can't keep up with it all through 2021. We're ordering, and a lot of times we're over ordering because you don't know when the next truck is going to be available or the next ship is going to be available. So you're like, oh, I'm just going to do a double order and hopefully that one truck gets here because I don't know when I'm going to be able to place another one, basically, right? And so I have all this coming in, and the problem is everybody did it at the same time. And so we have all of this goods, all these goods that were supposed to be Christmas presents, basically. They're all supposed to be Q4 holiday stuff that's getting in right now. If you look at the Port of LA this week, it's up 38% year over year. Next week, it's going to be up like 40%. And it's just because they have this big bubble of freight that's been waiting, 100 miles off the port that we haven't been able to get in because we have very limited capacity everywhere. And so we see inventory really starting to take this turn up. And there's two really good charts I want to show you to sort of explain why this is happening. This first one is from my friend Jason Miller, is professor at Michigan State University, and it's seasonally adjusted inventory or non-seasonally adjusted, and it's all retail excluding cars, basically. Okay, because cars are worth a lot, so they kind of messed up. By the way, if you're on LinkedIn, I couldn't recommend anyone more to follow than Jason Miller from Michigan State. He does amazing stuff with this data. Yeah. And cool. So yeah, and so you can see this red line right here. That's 2021. And look what happened in December. And December would be our most recent inventory data that we have right now.
Yeah.
Normally what happens in December is it takes a big dip. And you can see 2020, we just didn't have inventory the whole time, basically, right? You see how low that was. December, we didn't go down nearly as much. As normally we would think. And there's a couple reasons for that. One, we had all this inventory that just kept coming in. Two, and this is from the BEA, the Fed. Look at this. Look at the personal saving rate in the U.S. So we had these huge spikes, right? Stimulus, those three spikes that happened. And now saving rates are back down to where they basically were before the pandemic. And actually, this graph only goes to June, but if you were to extend it out to January, we would actually be slightly below where we were pre-pandemic. And so we had all this money in our pocket. And what do we do with it? Well, spend it. And we were specifically spending it on goods because it's like, well, I can't take the family to Disneyland this year. I guess we're just buying a bunch of shoes or another TV or whatever happened. And so we had this sort of artificial bubble in the goods supply chain that got really, really hot. And companies had this sort of Sophie's choice, which is, well, I could miss out on all these sales that are going to happen in December, which I don't want to. Or I could just stock up like crazy, and then I'll deal with the check in the morning. Basically, I'll deal with this in January. And so a lot of people took, all right, I'll door number
Again,
two.
right? That's my whole point of the cashless cycle. It's like, okay, I mean, obviously there's this decision behind that, and the decision obviously is the same outcome as most things, right? Is this going to be profitable, right? Is this going to, obviously the companies and organizations that are making these decisions obviously think it is. It will be interesting to see how, we've talked about this before, especially the big retailers their earnings report are coming out in a few weeks.
Oh, yeah.
Well, obviously, I'll want to discuss this, against LMI, next month for for February, right? And uh, you know, we've had such a long runway to plan for these spikes, right? And so people have implemented, right, solutions to meet these challenges. And how well or how effective did they compare against their peers?
So
You know, and
Walmart's an interesting one because their inventory specifically was up 11.5% from where they would normally keep it in
they
November, and
have the
that's a
space. Not
huge
everybody
number.
has the space either, right? They've have had, DCs and extremely large ones in, perfect logistics corridors on perfect highways, so they can meet, if you do like a density study graph to their customers, right? You can easily see, price and service in those corridors to, based on the highways, they can get to those, those end customers in the same day. When you talk about, final mile opportunities, or even, being able to, deliver same day, next day, I think they have a kind of a critical advantage or, for just their existing footprint, right? I think you just need to
Yeah.
obviously combat that with obviously the execution, and obviously there's costs associated with same day freight. If anybody's seen the prime rates increase, and the delivery days, the deliverable days are extending out, right? So interesting there.
Well, and then what that does is, so Walmart and guys like that, Costco, Amazon, they can figure it out. What's happening, and here, I'll go to the next slide here because you can see the transportation.
Too big to fail, right?
Right. So what's happening is, all right, transportation capacity has been declining every month, essentially for 2 years. Basically since May of last year, available capacity has been down. They've 30s, 40s.
And that's across all modes of transportation.
Is everything.
Some more than others, but yes, all modes of transportation are affected.
And so what happens here is, Walmart can just write the check, like you said, and they're so well positioned.
Or I get my own boat, I get my own plane, I have my own fleet of trucks, right?
Well,
I
who's
get,
really being hurt here, like a lot of this inventory that's just coming in now is like, small stores in the mall, like American Eagle, Abercrombie and Fitch. Basically, if you were a place that I thought was cool to buy jeans from in high school, you're in trouble right now. Because basically what happened is they paid the extra cost.
Well, by the time they get them actually to the shelf, if you're in high school now, you might be able to buy them at your senior year at Colorado State University.
That's right. Yeah.
Are they going to be in style?
Yeah, you'll look like the coolest kid from 2006. But so basically what happens is they paid this extra money, and now stuff's just showing up now, and you're gonna have to see all these markdowns all over the place to try to move things. And it's just like you said, we're gonna see over $120 billion of returns, just returns alone, this month and last month. On top of that, I think in February and March, salvage dealers are going to continue to be happy because we're going to have all these overstocks. And remember, with the secondary market, which is about $640 billion a year, overstocks are probably 60% to the 40% of returns. So we have a huge wave of overstocks that's about to come in. And so basically what's happened is all this capacity got soaked up to try to move things. That's why you see what's happening in transportation. And warehousing is I can put the pictures up and they'd be the exact same arcs you see here. And so basically what happened is there's no space left for the little guys, or if there is, it's really expensive. And who's really getting hurt too is like high moving stuff. So you might be thinking there's a disconnect here because we're saying there's all this inventory in the system, and yet there's stuff that like grocery stores can't fill their shelves. And basically what's happened is all this capacity is getting used up. And so the high turn stuff, like commodities, grocery, things like that, is falling behind because there's just not available capacity. Even if it is someone like a Kroger who could open up the checkbook, it's still very difficult just to even find anyone who will take your money at this point. And that's reflected in the graph next to it, the transportation prices, 88, which seems pedestrian given the last 2 years we've had. but 88 is a crazy level of growth. And we've now been over 80s for whatever it is since August of last year. So 17 months. We've had scores in the 80s or 90s. It's just, more of the same in some ways, but I think really what happened is we hit this peak around the holiday, and it really did separate the haves and the have-nots. The people who can afford it, the people who can't, people who have their own fleets, the people who don't.
Right. And we've talked about, reshoring before in our CSE and B roundtable, where we had a guest, Tim Lovely, who really articulated well. Is like, we're not going to get away from, from South Asia just because of the pure cost of goods, right? It's, you know, if you're a small or micro organization, right, you're not going to reshore. It makes zero sense. You're not going to be able to, find profitability there. However, these small micro organizations, we've seen a rise in these kind of multifaceted 3PLs, basically the soup to nuts, right? Full supply chain from, freight bookings overseas to warehouse fulfillment, pick, and all the associated things that go along with that. You're starting to see those organizations do really, really well right now, and for good reason, right? They're basically providing a service, but they're taking all of, your freight and other people's freight and be able to go out to market to resell, and obviously make sense of, staffing and, for providing those services to organizations. And thankfully, like, technology is readily available to do that stuff if you have obviously the expertise behind there to, architect a solution. But it's still it comes at a premium though, right? It's not just like, hey, we'll just have FedEx do it all, and here's my per cost per unit, and here's my, here's our retail costs. It's really simple. It's obviously, the people that understand that complexity is there, understand that it's not like turning on a light switch either,
Well, it'll
unfortunately.
stay at a premium. The last slide I want to show you is our future predictions. So every month we ask our respondents, hey, where's this going the next 12 months? And, warehouse capacity 51, transportation capacity 60. So there's a little bit more hope, for transportation coming on.
What
Warehouses,
what about
it's just,
the salaries for associate professors of supply chain management? I don't see that on here.
well, so I'm an assistant professor first off. I go up for tenure in the fall. So hopefully next year we can start getting associate. But they're look, man, we're doing fine. It's supply and demand. There's not a lot of this out here. And suddenly supply chain is one of the most popular majors in the country. So, it hasn't been bad. We're not doing quite as well as, say, ocean carriers, but it's not a bad time to be teaching supply chain.
Like I say, it's good dinner conversation these days. Where, as before, not very interesting.
No, I used to just have to tell people I teach Amazon, and they'd be like, "Oh, okay, all right, I get that." They no one knew when I said I teach supply chain. It's funny, actually. I talked to a freshman class this morning. Right before this, I had to talk to a freshman class. That was the other presentation this morning that I had to write 5 minutes before it started. And it's funny. It used to be I'd go in there and say, "Hey guys, what's supply chain?" None of them would know. One guy one time, and these are 18, so you gotta get cut some slack. We said it's manufacturing of chains. I said, yeah, man, we got a whole major just about chains. But now they all know. They all know what supply chain is. And because of this graph and the ones that we've seen where costs are going to stay high. It's going to be in the 80s. And one of the things that's interesting, the main difference between our future predictions this month and what we saw last month is inventory. Inventory levels now, 73, that's a very robust rate of growth. In fact, we've never had 1 month of inventory at 73. So if this is where we are, in a year, that means we've really now we're totally on the other side of the bullwhip effect, and we're trying to run this down. Now, I do think because there's a couple things to keep in mind. Basically, consumers have been able to absorb inflation, and supply chains have been able to absorb inflation because consumers were absorbing it. But now we saw that savings graph, and it's so much lower than it was. Basically, we run through our stimulus. It looks like we're not going to renew, child tax credit, stuff like that. And so there's going to be less consumer spending happening, and it's going to take a total reorientation of supply chains. Now, you might be able to get out from under some of it with returns to the manufacturer or somehow cutting, you can cut some pieces of your ordering, but, up the chain, they saw all this going on, and there's been big investments in components and raw materials and things. So wherever the inventory happens, even if it's not happening at the retail level, it's going to be happening in the supply chain throughout the next year, because it looks like what maybe is happening is big spike. Now we're kind of, we're going normal, huge dip, big spike, back to normal, which is exactly what it was going to always be. We all knew that was going to happen. The thing is, you didn't know when it was going to drop back down, and nobody would have guessed that drop was going to happen in December of all months, which is why we have all this inventory in June.
Well, in the cycle, it's nothing new. We just haven't seen the dramatic effect.
No, we fit a 5-year economic cycle into 18 months, basically.
Yeah, it's like, we never assumed it was like as dramatic. So yeah, these things are predictable somewhat, right? But again, where it happens and when and to the degree of intensity is
that it would happen, but didn't know when, right? We all knew Tom Brady was about to retire, but then he did, and just suddenly happens.
Yeah, I'm looking at this and I'm going, okay, so we've had a 21-year planning, we've retooled, we've had some thought content, some investment by organizations, right? What are we going to do to meet the challenges of today's supply chain, transportation, and logistics environment, right? We've seen those played out. People are getting smarter, right? Because they've lived the life, right? They've done the work, and now they're retooling and reorging for this year and beyond. And I've seen a couple rules that I really thought that caught my eye, right? And it's like an internal optimization position is one that really caught my interest. And maybe we're just calling it something else, but I was thinking about like Tommy Boy, right?
Yeah.
So Tommy Boy, right, one of my favorite comedians of all time, Chris Farley, right? Not the movie or the comedy itself, but Callahan Auto, right, where this character plays, right? There's a manufacturer, and they have a shipping facility that comes in a very small part of the movie. However, for supply chain and warehouse, transportation folks are like, ooh, cool. There's a shipping office. Anyway, and she's doing things, a process that works for her that may be antiquated to other times. Well, hey, going into organizations, integrate processes that work. Hey, great, right? As long as that person doesn't leave or retire.
Mm-hmm.
A lot of tribal knowledge that goes into housing there, but hey, it works, whatever, right? So now we're really challenging the marketplace to say, hey, we're going to fill that person with automation. Is that the best way or right way? I don't know. You say technology in a certain room, it's you kind of scare the crap out of people, right?
Well, one thing that I think to keep in mind is, even if we do see a slowdown in consumer spending, it's going to be a different type of consumer spending than we were seeing before. And this goes to what you're just saying with the importance of automation and rethinking strategy. E-commerce is 14% of retail last year, up from 11% the year before, which doesn't sound like a lot to go up 3%, but that 3% that we moved up is the same amount that we moved up from 2006 to 2013. So we moved basically forward 7 years in terms of as a percentage of retail. It was still high this year. It's going to be 25% in 2026. So what that means is, even if net consumer spending goes down, more of it will be your e-commerce, last mile delivery, all this stuff where you still need to have a more built out logistics infrastructure network. And that's why, companies or respondents can see, spending might be going down, but we're still not going to have enough capacity. And the cost of trucking is still going to be expensive this year. Even if consumer spending stays flat, trucks will still be expensive because we need so many more of them, because the way they're spending their dollars is different. And that's really what we're going to come out of the pandemic with. The economy is going to be relatively the same. The difference is that it's going to look different, right? Where the weight is positioned is going to be very, very different. Sometimes I tell my wife, I'm the same weight I was when I graduated high school. I was 180 pounds. It's just a very different 180 pounds than it used to be. There used to be some muscles in here somewhere, and now it's not. And that's the same thing that's going to happen. The same thing that's going to happen with I think retail through 2022.
Yeah, and I think that's not a bad thing, right? For the most part,
eventually, man.
I've architected plenty of these final mile solutions to understand when you put all the the different segments together, and your end cost, you're like, oh my, like sometimes it's not the best option, right? Because you're looking for a target or some sort of ROI here, and if you can't prove it, right, with current, what do you call it, people, process, and technology is probably the best way to describe a good architecture, just because it is something that you could execute on. Sometimes it is super expensive, but now with the cost and escalating, maybe not, right? Will consumers pay more to have it delivered to the doorstep? Well, again, depends on the item, depends on the person, right? So, I guess the market will decide that, and it probably already has, and I'm sure someone already has the data on it, and it's probably listen, you know, the same people are watching every email and phone call and word I say on my device. But, um, you know, back to this optimization role, it's funny because the last point I want to make is the deliverable that this optimization role has is almost identical to what a third party logistics organization would build from a managed transportation solution, right? Or the specific ROIs and opportunities that you look internally, instead of hiring a consultant or a third party organization, it was like, hey, why don't we just hire someone to do that best in thought content? If we can pull it off ourselves, right? There's a position available for that. I'm like, I love that, for that specific reason. We can absolutely help ourselves without the help of someone else by creating a job or a department in an organization, or give people in different departments that have ideas, give them a voice, right? If you're
Absolutely.
in warehouse and you have an
Yeah,
idea,
it's the
right? Like,
quality
hey,
management. You got to
raise
hit
your
the power at
hand.
the bottom to make the top work.
Yeah, it's like, hey, raise your hand. It's like, hey, I noticed something.
Yeah,
You
maybe the
know,
people who do the same thing, who work on this every day, they might have some insights into it.
Maybe. I
Yeah,
mean, from my experience, those are the people that they have the best information. So when going and do an assessment for any sort of partnership, right? I make it a point to talk to all the operators to absolutely understand their constraints, right? Because again, taking roles out of their hands, making their lives easier, right? I mean, isn't that the goal of every good partnership?
absolutely. Yeah, absolutely.
Or one of the parts of the 4E key outcomes.
That's right. I know.
Or-
Quoted my students many times after you mentioned it. Anyway, I thanks as always, John, for facilitating
And
the
thanks
Zach's
for our
corner.
audience for
Yeah,
participating. Go to the LMI, follow it, update, provide shared data. Hey, this is a community here. Um, so
the LMI is for the people by the people. It really is. We take as many insights as we can get, and then we give them out for free. That's kind of our
it's not
model.
Zach's corner without Zach.